What's happening, y'all? Christopher Griffith with Vetted VA on Monday, and we have Helmer here as well with us to talk about interest rates, mortgage, bonds, all of those things that inform a lot of the questions that you have. But hopefully, to a degree, you understand the answers to the questions you're asking, because that's always our goal, right? To teach, educate, inform, and make purposeful the complexities that solve your problem and the answers to those. So, I guess Nathan didn't hop in today, which was cool. I was getting ready to roll. I didn't know if I should pull back or not. So that started. But got a few things to discuss with y'all. I think we're going to drop some clarity points on shopping, as we like to talk about on here. The number one thing you can do to make certain that you're achieving the highest and best, considering your perspective as a consumer activity. It's the number one thing you can do. So Hammer, tell us a little bit about what's going on kind of in the market right now, what happened since we met last week, rock and roll your side of these things.
Awesome. Nathan, would you mind sharing the screen, please, if you can, on the back end there? Fantastic. So let's go ahead and talk about rates today, December 6th. Let's see if we can move that. All right. So quick recap of last week. We were afraid rates would be a little bit erratic last week because of a couple different variables that were at play. The first was the newest variant of COVID, Omicron, which has markets kind of shaken up. And when we talk about COVID and mortgage rates, it's a different conversation than a normal COVID conversation. What we're really focusing on is what is the effect that COVID and the reaction to COVID is having specifically on the markets like stocks and bonds, and therefore how it's going to affect mortgage rates. So last week, things were a little bit erratic as everybody is, starting to figure out just what the effects of Omicron are going to be. And the biggest concern for mortgage rates is how it affects stocks. And with stocks specifically, they're worried about how is this newest variant going to affect the global economic recovery? Does it mean more lockdowns? We'd seen some travel bans. So that was at play last week, and it caused a little bit of erratic movement. And the other thing that's a big issue is inflation, which was also at play. And last week, we got a little bit of shakeup because of Fed Chair Jerome Powell, who was testifying in front of Congress, as he does twice a year. And he testifies in both houses of Congress, in front of the Senate and also in front of the House Financial Services Committee. And in front of the Senate, he kind of dropped a little bit of a bomb and shook things up on us. And what Fed Chair Jerome Powell said last week that nobody really was expecting was that the Fed is kind of come to terms with the fact that inflation is not necessarily as transitory as they expected it to be, meaning it's been a much longer term problem with the increased inflation. And the Fed has what they call dual mandates. The Fed's goal is to keep inflation at or near 2%. And they're also trying to maximize employment, which is a moving target. But right now, maximum employment, is generally considered to be an unemployment level of 4.1%. So last week, Fed Chair Jerome Powell said, hey, inflation not so transitory, and we may speed up this bond tapering thing that we're doing in order to basically facilitate raising the Fed interest rates later on, which will be in earlier of 2022. So we can go a little bit deeper on all that, but that kind of shook everything up last week. Gave us a little bit of erratic movement. Rates, kind of reacted poorly, then poorly again. So they kind of moved around. And when we say rates moving, by the way, everybody, interest rates themselves may not necessarily move much, but we're also monitoring the rebate pricing or the credit that you can get towards your closing costs from your lender, or the cost that it would cost you to get a particular rate, which is usually referred to as points. So a lot of times there's small movements in the market, small movements in interest rates, where if you were quoted, say, 3.25%, you would still get 3.25%, but maybe 3.25% on Tuesday, it would cost you $500 to get that rate. You would have to contribute into the closing costs an extra $500. Whereas 3.25% on Thursday, you may actually get a $500 credit towards your closing costs. So there can be a swing that can be significant in out-of-pocket costs, and that's why we monitor that as well. And then a quick recap on what do we think is going to happen. Our forecast for where we think rates will go this week, they're really not going to move much. I think they may creep up a little bit towards the end of the week from where they are now. But again, it would be more of that movement in the day-to-day rebate pricing, meaning what is it going to cost you to get a rate, or what kind of a credit are you going to get for that rate? You'll see small movements in that day-to-day, but I think rates themselves are going to be relatively stable. As we go towards the end of the year, they'll probably creep up a little bit more as we get towards the idea that the Fed is going to raise rates. The biggest concern this week is actually not a concern this week; it's a concern for next week, and that's going to be the Fed meeting that's going to take place next week. So right now you'll see markets speculating on what they think the Fed is going to announce at next week's Fed meeting. But that Fed meeting next week, which we will talk about a little bit more next Monday, that's going to be the big market mover, and that'll kind of control where rates go from there. So this week we've got just a couple of things that will be affecting rates. We've got some economic data. Mainly there's some treasury auctions, which those you don't really need to go too deep on what they are, but they do have a small effect on rates each day to day, depending on how well received the treasury auctions are in the markets and whether there's an appetite for treasuries. And then the inflation data that we get on Friday is probably something that we could see have a small effect on mortgage rates on Friday. So that's something to be aware of. We've got the Omicron news, which thankfully it looks like this is even though it's highly contagious, it looks like it may be lower as far as the symptoms, milder symptoms. And as that stuff kind of comes out, that sets the minds of investors at ease that there'll be less of a concern over the effect on the global economy and on the economic recovery. So therefore, we'll still be keeping an eye on that. And then the last one is the Fed. The Fed's meeting, like I said, is next week, but it's a speculation. It's the buildup that'll have an effect this week. So that's kind of it as far as rates, in the forecast and the recap. What do you think, Christopher? Any questions on that?
No, I think that kind of bland is the expectation, at least to some degree. I don't think anything super crazy surprising, probably, but the Bitcoin folks aren't saying the same thing over the last little bit, right? So that was interesting to see. There's a lot of different volatility, I think, that exists in the market. The market being an incredibly broad, short word for the number of letters, but across the board. So out of curiosity, I mean, you follow when we talk about U.S. mortgage rates, bonds, and all of that stuff a lot. Does the U.S. market move in somewhat parallel to world markets, other countries that have credit and debt in some semblance of the manner we do?
Well, we still have the number one economy in the world. And it's the most stable. So when other countries are looking to invest and they are willing to take a lower rate of return, but they want stability, they'll invest in our treasuries because they're backed by the US government. So that's always a big part of what it is. And then mortgage bonds are also very popular because although a little less secure than treasuries, it's only a little bit, and they do have a better rate of return, at least a slightly better rate of return. So yeah, we do. We see a lot of global interaction where China will actually buy a lot of U.S. bonds, and they'll buy some mortgage-backed securities as well. And we see that in other countries in Europe and some of the countries in Asia as well.
Cool. And just to perspective, because I know as soon as people hear that, like these foreign countries buying our debt, right, they equate it to be some massive piece of the pie overall, but it representative to the aggregate share of what they're purchasing. I think it's important to note that it's a very small portion. It's not some avalanche-sized thing that's just overarching. I think a lot of people lose that in hearing the first part.
Very good. Very good. So, well, unless there's a particular rate question, I think one of the questions that I saw in the Facebook group that talked about rates and was kind of when to shop for rates and when to shop around to get the best rates. So let me go ahead and pull that up and we can kind of go over the highlight. The situation was, the question was, at what point do you shop for a lender? And this particular member is looking to close at the end of the month, December 30th. And they like their lender. So it sounds like they're working with somebody now, but they see everyone talking about shopping around and possible lower rates. I know everyone's situation is different, but we want to be sure. We have excellent credit and low debt to income ratio. Everything is overwhelming: fees, APR, and interest rates. So Christopher, with that kind of on there, let's spend some time talking about that. And my question to you is when should somebody shop around for their rate, and when should they not necessarily shop around?
That's a great question. And there's really two opportunities, I think, that are most prudent for consumers to shop at. And so pay attention here. I think that you should shop as soon as you're getting pre-approved for the mortgage. And you're doing this for a few reasons. One, it familiarizes yourself with the documents that are necessary for you to see the variables and understand them in order to shop apples versus apples. So same day quotes, same day estimates of what this would look like for you, right? And how it's broken down and what you're being offered as far as an interest rate and what's it costing as far as origination or fees or discount points. And it'll let you see that total picture right up front, which will give you some semblance of understanding of who's better, right? At least from an interest rate and cost perspective. And it's important to note that that's not the most important thing. Saving 1/8% on an interest rate is generally something that doesn't interest me as much as terms and lender I'm working with because of a lot of the different values there. But that said, it'll let you understand their expectation from the beginning. 2, it's going to put you in the process of practicing the shopping activity, right? So that you become familiar with it. And 3, it's going to establish a line in the sand for them. And when they declare, once you get under contract, which is the second point at which you absolutely must shop here, okay? Even if you don't do the first, because you kind of want to be lazy, whatever, it's not great for you. But when you get under contract, that's when you're actually on the line. You're getting ready to engage the target, right? And so the first will let you see how they're set up. And if there's a massive change in how they're charging you and how they're structuring your offer for your loan product from the first pre-approval to when you're under contract, that should be at least a flag to say, hey, why is this so different in how you're displaying the cost and information around this loan to me, right? But the second point, once you go under contract, right, and now it's important you're getting ready to submit your loan to a lender to be underwritten, to have an interest rate locked, right? When you go under contract and you shop at that point, the lender is more likely going to be forced to offer or show you something that can be locked right away. And that's something you want to tell them. So you want to shop on the same day then too. And you want to tell them, I want to see something that you can lock today, which sets a time impetus to it, right? And then you'll have 2 or 3, 4, whatever you choose to shop with. I recommend at least 2. It probably should be 3 or 4 to tell you the truth. Shopping is the number one thing you can actually do to make sure that you save yourself or get yourself to the best position you could. And so doing it the second time, once you go under a contract, will force those lenders or compel them to offer you something that's immediately lockable, and no more migration really to it can occur at that point, right? And so that's why the kind of the 1-2 punch, I'm a fan of that. I think that everybody should go through that repetition to become familiar with it, because when they don't, I see the result of it, and they don't get as good as they could have. Very simply put. And it's not by like 30% of the time. And I don't even have an exact percent, right? Statistics are mostly made up, but nearly always, if you don't shop, I bet you money you could have done better. Nearly always. So if you're out there and you're like, I didn't shop and I could have done better, take that bet and give me a call, and I will make it my purpose to show you the value of shopping without gaining or benefiting, other than the fact that I want you all to accept the fact that you can shop for your mortgage. It's not hard. It doesn't hurt your credit score when you have multiple credit pulls on the same day or in the same few days or weeks period of time in the same avenue for a mortgage. So it doesn't harm you. It only saves you money, and it just costs a little bit of time, but that is going to impact your understanding, which is a huge gain potential for you and your family.
Right. But once you do go ahead and lock in your interest rate, a couple of things. One, lock it and then let it go. Because we can get fixated on interest rates, and there's no such thing as the best rate. Rates are going to change daily. And in fact, they can change during the day. And I asked Nathan to throw this up on the screen. I wanted to give everybody a quick lesson in what we're actually looking at as mortgage lenders and why interest rates change. And we talk about this quite often, so you may have heard this before, but for those that are new or your first time joining us, what you're looking at, these are called Japanese candlesticks. This is a particular kind of chart, and it's monitoring a particular coupon. And this one happens to be a 30-year UMBS 2.5. And what that really means is it's a mortgage-backed security, and it's a 2.5 coupon, meaning for an investor, they're going to get a rate of return of 2.5% on this. And in order to buy these bonds, they're going to buy them for the price that we see. So they're buying a $100 bond right now at a premium of 102.31. They're actually overspending on this. And that's because they're going to get a better rate of return over the life of the bond, and they're willing to pay a premium to get that rate of return. Now, during the day, what somebody is willing to pay on this bond will go up and will go down. And as those prices go down, as people are not willing to pay for these bonds, then what happens is interest rates would basically worsen over time, because there's not just a 2.5 coupon. there's also a 3 coupon and a 3.5 and a 4.0, and they work their way up actually. So this coupon, because it's giving a better rate of return, it's getting 3% for the life of the coupon. When you buy this bond, you're going to get it for 30 years and it's going to give you a 3% return, but you're going to pay 103.69. You're going to pay an extra premium, because that basically you're getting a guaranteed rate of return that's higher over the life of that bond. So right now we're watching the 2.5 coupon, and that's the one that's most relevant to your lenders. And this is where they set their baseline for pricing. And why do you shop around? And what is Christopher saying? Why can you maybe find a better rate? Lenders all have a different margin that they're going to add on top of it, but they're all going to be basically going into the same pool. And this is our starting point. And then your lender margins, whereas say Christopher is going to lend you money and I'm going to lend you money and you want to borrow $10. And Christopher says, all right, you want to borrow $10 for a week. And a week from now, you need to give me $11. So I'm going to make $1 margin on that. And I say, well, you know what? If you're going to borrow money from me, you're going to have to give me $12 in a week. I'm going to make $2 on that. And that's why interest rates are different from lender to lender. But the reason that rates generally move from day to day, or sometimes even in the day, is because of the movements in this bond market. So right now, this little squiggly chart down here in the bottom right, this is an interesting one to take a look at. This is the movement on the price of those bonds as traders are trading them during the day. And the high points are when you see a little bit better rebate pricing and lenders are actually like, hey, we can actually pass this along as maybe a slightly better rebate to our consumer. And then when it gets down or gets worse, there's a risk that the lenders may say, okay, we're going to be borrowing money at a more expensive cost. So now we have to pass that along to you, the consumer. So it's going to be slightly worse. So that's why it's important that you check interest rates every day. And that was one of the things Christopher said was do your due diligence in the same day, because comparing where rates are at today compared to all these squiggly lines where they were last week, where they were after Thanksgiving, those are all different days, and there's different rates each and every day. So this is some interesting thing for those of you that may say, hey, why do rates move around so much? And why do we see this movement from day to day? And this is actually what's happening behind the scenes and what is actually causing that movement. And for you may not have access to these fancy charts, but one thing that you can get a really good idea of which direction rates are generally headed is by monitoring the 10-year treasury. And it's not a 1-for-1. In other words, if the 10-year treasury yield goes higher, it doesn't mean that mortgage rates are going to get worse. If it improves, it doesn't mean that rates necessarily get better, but they are going to move in those same directions as a trend. So as you see this 10-year treasury yield number go higher, right now we're at 1.43. And if you see that yield go back up to 1.5 or 1.6, or where it's hit for the high points of this year has been 1.7, that generally is going to correspond to mortgage rates also getting a little bit worse. So that's something that you as a consumer can just use as a reference point, as a rough reference point of, hey, which direction are rates really moving? And that's why right now rates are a little bit better. And you'll notice this 10-year treasury yield is better than where it was before Thanksgiving. And that's why we've got that situation. So I'm looking to see if anyone had any questions. I'm just looking through the comments. Christopher, anything you would add on that? Did that make sense? Did we kind of...
No, I think it makes a lot of sense. I think that it's something that, again, if you're out there, if you're watching this video, you're like, well, it doesn't make sense to me, I still don't get it, then follow along to the videos. Go back and look at the past weeks. There's some different breakdowns in them. It's a complex subject, and you're not going to probably get and understand all of it because there are a lot more things that play into what impacts you when you're trying to make the choice of what's the best rate, right? Well, approach that word or that question like the coldest beer in town, right? Yeah, you can't market coldest beer in town because it's not a checked thing. It's a marketing ploy, right? And so the best thing that you can do is drive around maybe and reach in the cooler and fill them. Shop for your coldest beer in town and get an understanding to the best that you can of the different things that impact the quality of the thing you're choosing. So whether it's rate, cost, fees, terms, all of those things, or ability, right? Not all lenders are the same. Not all lenders choose to impact or do the same types of loans, right? And another thing you said, I think a lot of people may not know, is you said the lender's borrowing money. It's like, wait, you mean it's not their money? I think a lot of people think the lenders have these massive hoards of cash in the back of their big buildings. They're lending their money out to you so you can do this thing. And that's why they get all of this control. But is that actually how it happens, Hammer?
Nope, not anymore. That's how it was back in the 1800s. Depositors would give the bank their money and maybe get 1% back, and then the bank would lend it out at 2%, and they made money on the difference. And that was how banks made a profit. But today's banking is very, very different and much more complex. And the amount of money that moves around, or the liquidity in our markets, is much, much bigger. So banks would not actually have enough depository funds to loan out money on all these houses and all these cars and all these student loans and everything else. So we have markets where that money is actually securitized, and it's sold to investors who are then able to, kind of buy that debt, and that's when they service that debt, and that's where they make their money. So that's what Fannie Mae and Freddie Mac and Ginnie Mae. You may have heard those names, and those are not just my cousins. Those are also people, those are organizations that securitize those loans. So lenders, mortgage lenders, whether they are a bank like a Wells Fargo or a mortgage lender that doesn't do depository funds, they don't have checking and savings accounts, but they only handle mortgage money. They're basically going to go to the same well, and they're going to be selling that debt to the next in line to securitizers so that they can replenish their funds and have more money to lend out. And that's the circle of lending as it goes.
One more fun question. If I borrow $100 for a house, do all 100 of those dollars exist at this very moment before I borrow them?
Now you're just going deep on me. Now you've got that whole, if the tree falls in the woods and no one's around, well, it doesn't really make a sound going on.
I think that a lot of people may appreciate the pursuit of the question is, what is debt? Is debt borrowing money? Is debt buying money? Is debt creating money? And so maybe that's why the question of, if I borrow $100 now, do they all exist before I engage the market to borrow?
I don't know. Now, see, that one I can answer, but I can tell you one thing. If you borrow $100 to buy a house that goes up in value 110, you still need $10. So it's buying a home is a fantastic way to build your wealth, especially from generation to generation. And even if you take a loan to buy a house, David Ramsey is wrong. It's a great thing to do because you're going to prosper in the long run.
The data proves it. The data proves it. If you're interested, Harvard puts out a home ownership study, and they have for a long time. They put out one in 2011, kind of right central in the backside of the housing market crash when everything was terrible and it was never going to recover and all this and the other. And they show with data that the number one thing the majority of Americans that have never had wealth can do to change that is by purchasing a home and maintaining ownership of that home. The VA loan does that more efficiently than any of them out there. From a cost structure to a time structure to an affordability structure to a security, how likely you are to maintain it structure. And when you're transitioning from state to state, it does it even more efficiently there. It does it more efficiently for minorities. It does it more efficiently in a bus. It does more efficiently without cuss, right? Like it cat in the hat this puppy, because the VA loan is the best, supreme. And I'm willing to have that discussion with anyone that thinks differently. And it's important for you all to understand, because it is that significant. Home ownership and the tool that you've earned contractually already. You engaged in this debt instrument and that purchased your ability to access this thing. Don't let anyone rob it from you. And if you're about to, maybe have a discussion with myself, with Helmer, with Nathan, with any of the moderators here, so that we can at least help you to understand the total context of the thing that you're choosing. It's important.
Very good. Well, that's all I have for this week, unless you have something else that you wanted to talk about or go into.
No, I think that was solid. I think appreciate everyone's attendance to the market discussion. I know it's kind of hard to follow along with, maybe if you don't have a big background in it. Pay attention as we go through week by week. Search back through the previous discussions, which all kind of reveal a little bit more, I think, context. And watch for the cheeky Crocodile Dundee hat that lets you know Helmer's about to come by and drop the rate info. So we'll keep y'all up to speed with what's going on. We certainly appreciate you, as always, being a part of this community, being a part of this tribe to help veterans achieve home ownership, because it matters, especially right now. It matters.
Absolutely. Thank you for having me.
Absolutely. Blessings, y'all.
Take care, everybody. See you next week.
Outro.